Let me, in that spirit, welcome in Prashant Jain, who's with us, founder and chief investment officer at 3P Investment Managers. Prashant, great to have you with us here. Good afternoon. Appreciate your time here on CNBC TV18. So, just how you are thinking about the correction that we have. What's the frame? Would you use a particular framework, like, for example, what we saw, like the first trade war in 2000, the last trade war in 2018, or the COVID period, or something before that? And how much have we lost? Where we are? Just your thoughts, Prashant.
So, Prashant, let me share with you a few key points. One, India's exports of manufactured goods to US is just around 2% of our GDP. And so the impact should be quite small in that sense, right, of these tariffs. Second, our tariff gap with our key competitors in exports, goods exports like China and Vietnam has actually increased. So it's a small advantage. But in any case, it is just 2%. So I don't think that much is going to change. Now, as a result of what is being done, oil is down. And since US fiscal deficit should move down sharply because of the tax collections that will go up, the bond yields have also moved down. These two should work to our advantage significantly. And finally, I think the US stock markets have fallen very sharply. As we all know, last few years, US markets have been the biggest recipient of equity flows worldwide, what came to be known as US exceptionalism. I think this might just mark the change of that trend, because the negative effect of wealth, negative impact on the economy of the wealth effect erosion in US might even lead to some sort of a slowdown. So I think if US is no more the favorite country, most other countries which are resilient, and that certainly includes India, should benefit. Around the same time, the IPO markets in India, as we all know, have virtually, the capital raising is down by maybe 80-90%. I don't see that changing in a hurry. So net, I feel there is reasonable value in large caps. Small mid caps, I would still be cautious. But reasonable value does not mean 15-20% kind of returns. I feel near GDP, nominal GDP growth rates, 10-12% kind of returns is what would make sense to my mind over a 2-3 year period.
Fair enough. And I think you've sort of emphasized and hammered that point on for a while. The last time we spoke as well, you said expect more reasonable returns. What you saw over the last 4 years was extraordinary and maybe will not repeat from here. The fear, though, and you mentioned US sort of deficits will go down as tax collections increase. The fear is that these tariffs will cause a global recession and will negate any benefit that accrues. And you began by saying share of our exposure in terms of goods traded is very small to the US, so direct hit is low. But the impact is supposed to come from this global recession if it were to happen. How are you thinking about that, Prashant? And that goes to the heart of the issue. Are they really going to stay the course? I mean, are they really going to try and rewire this entire global system and how it has operated for the last 30, 40 years? Will they stay the course? Is it ideological? Or will they pull back from the brink once the market starts to, it's already, of course, deep in the red, but if it falls more, they pull back from the brink. What's your sense?
The second point, I think we'll have to cross that bridge as we come to it. There is no point in speculating on that. But what I said is, as of today, as things appear to be today, as far as global recession is concerned, see, India's correlation with global GDP growth is extremely low. You would probably recall, even in the Lehman year, India's economy grew 5.5%. Because India's economy is predominantly local consumption led. And our goods exports is really very small. We are predominantly a service exports economy, which also may not grow, may even come off 1-3%. It is possible. But net, the impact of global slowdown on India is likely to be far less than in most other EMs, which are large exporters of manufactured goods. Also, if there is a recession, oil will remain extremely low. So we may actually benefit more by way of saving on oil than what we possibly lose out on exports of goods. And finally, see our share of global exports in manufactured goods is so low that we have to grow by market share gains. If we as a country start relying on market growth to grow our exports, then it is certainly not a good thing for us. So the way we have grown in IT exports, we have grown much faster than the markets because we have gained share. So I think India's bulk of the growth, I would say 60, 70, 80% in exports of goods should come from market share gains and not from market growth itself.
Prashant, hi, afternoon. This is Rima here. So, in a nutshell, do you think the worst of the pain is behind us right now? Because we're still down about 16-20% from our 52-week high levels, and we're just, 3-4% away from the 52-week lows that we hit in June of 2024. Is the worst of the pain behind us? And are you putting money to work at these levels in large caps where you're more comfortable with the valuation?
So, Rima, I don't think you can, me or for that matter, most others can time the markets in the near term. What we can only comment on is how our valuations behaving, and that gives you a fair sense of how the medium term return should turn out to be. So I think at current levels, Indian markets are Nifty is trading, I think, close to 17 times fiscal 27 earnings. India's cost of capital is quite low. The gap between US or rather Indian and US yields is 2.5%, which is close to all-time lows. So that reflects the low cost of capital that India has. At these multiples, given this cost of capital, I think a 10-12% earnings growth is enough, which I think, by the way, is also a realistic number for earnings growth. So I would say, I don't know how short term will pan out. Next few weeks, months could be volatile. There is some correlation with global markets in the short term. Short term, people should invest in phases. But if you buy large caps, I think over a 2-3 year period, we should get low double digit returns. Small mid caps, I would still avoid.
All right. Hi, Mr. Jain. Good afternoon and good to see you in. Nigel on this side. Mr. Jain, I wanted to ask you, about sectors. And it appears that the banking and financial names, it seems to be a consensus bullish thesis on that. For today, the bank Nifty is a little bit low, but otherwise valuations pretty much intact. It's a play on the domestic economy as well. What's your take on the banks and what do you like from there? Private banks, because PSU banks, between them, what is the preference?
Nigel, I think barring the consumer stocks in Nifty, in large caps, to my mind, most other sectors are looking reasonably valued. Banks, insurance, utilities, even if you look at automobiles with a medium-term view, pharmaceuticals, even IT. I mean, near-term growth outlook could be very difficult, but at these multiples, the yield on the cash yield is pretty decent. So I would say, by and large, these sectors look reasonable. In this market, fortunately or unfortunately, I am not able to spot any massive deviations or dispersion in valuations across sectors. So there are very few sectors which are deeply undervalued in these markets.
Prashant, hi, great to have you on this afternoon. It really helps to listen to someone who's seen these cycles play in and out, which is why I want to sort of, snap back into a wider question now, because you've seen this. You've seen the financial crisis. You've seen multiple drawdowns. Now, for a minute, if we just park aside all the trade concerns and the tariff issues, my question is a little more on technicals and markets. I was reading an article, for instance, in Barron's, where one of their editors, who's also been a stock trader, argued, and we've seen this play out in the past, when markets fall non-stop because they're interconnected, it can lead to other accidents as well. Now there's a non-stop fall. Tonight in the US might be a third day of a non-stop fall. What happened back in 08 was, once things started spiraling out of control, everybody jumped in to save the financial system, from central banks to the treasury, everything. Right now, obviously, it's nothing as severe as compared to that. But is that an outside risk if something is not announced tonight to stem the US market rout itself?
So I don't think we can guess these things. In the short term, the markets can always overshoot both on the, like they overshot on the upside some time back. They can shoot, move down lower in the near term itself. So I don't think I would be in a position to guess that. But I think as far as India is concerned, we are quite well placed. Our current account deficit is half of what it has been for a long time because our service exports have done exceedingly well. So, in that sense, we are extremely resilient. Bank NPAs in India are extremely low, as we all know. Corporate leverage in India is again extremely low. So, I would say India appears to be quite well placed. But of course, our return expectations have to be commensurate with the likely growth in profits. And we must appreciate that India is now a lower inflation, lower cost of capital country. So, to that extent, the nominal GDP growth and growth in profits would also be lower.
Which is what, the question is, and I'm going back to what you said, that if someone buys large caps now, expecting a, 10, 11 kind of a percent kind of a return should be pretty logical. So, should that be the new reality that investors have to digest? Post-COVID, we all got used to at least mid-teens returns, if not more. So is 10% the new reality in terms of realistic returns from Indian stocks?
It could be 10, it could be 12, I think, but it should be in that ballpark figure. You could add 1% of dividend yield. And so I think ballpark, you are right. I would expect that. See, the COVID returns post-COVID were primarily because of the extremely low base of both the markets and of corporate profits. Corporate profits to GDP around COVID had fallen to 1.1%. Currently, they are at 5.5%. So now there is very little room for margins to expand. So it would be difficult for corporate profits to grow higher than the nominal GDP or the top line growth rates of these businesses. And multiples, as we all know, are reasonably fair. So neither is profit growth going to be vastly, is it going to be superior? Nor there is room for multiples to expand. So that tells you that we should expect returns around the earnings growth, which is around 12% CAGR over a 3-year period, in my opinion.
Prashant, just a couple of more questions. You briefly, I think, alluded to how tariffs here, if they stay, we don't know how it'll pan out, but we seem to be reasonably placed relative to some of the competitors out there. We spoke with the management of Gokuldas. They're an apparel exporter. We had the management of Dixon this morning. We've spoken with other industries as well. So after 2018, the first round of trade tariffs with Trump the first time around, a lot of manufacturing moved out of China, but the beneficiaries were countries like Vietnam, Cambodia, etc. Do you think eventually once the dust settles, there is potential for share gains, because it happened, but not just in our favor back then? What is your sense, Prashant? Do you think it'll depend on the enabling environment, and one should not really pin our hopes too much?
See, this is going to be a long, slow, arduous journey. This is not like setting up a GCC that you can start it in a few quarters and you are up and running. Manufacturing, for supply chains to move, for factories to be set up, for employees to get trained, these are time-consuming things. So I think the environment is quite conducive for us to gain share. The government is very supportive. Our competitiveness is there. And as we discussed, these tariffs also and geopolitics also is supportive, in my opinion. But we have to be realistic in what growth you expect in the near term. Because, as I said, these are supply chains take decades to shift. So this is going to be a slow, steady, hopefully progress over a long period. So I am very optimistic that India will increase its share in global trade of manufactured goods, but at a very measured pace, because our scale is not there. Our costs are still not globally competitive in many areas. And in some areas, we don't have the ecosystem like we have in castings, forgings, automobiles. We don't have the same in electronics or semiconductors. So we have begun that journey, but it's a long journey, and we should expect results over 3, 5, 10 years.
A question on two sectors, actually, IT and pharma, export facing. General wisdom, going wisdom seems to be avoid because you don't know if the US too exposed and the usual reasons. I don't know if you have any strong thoughts here, these two sectors. And second is, you've been a close watcher of how oil prices behave and, I mean, its impact on India for as long as I remember speaking with you. And of course, oil is coming off very, very sharply. So that, it's hugely disinflationary. That should allow, authorities here, the RBI meeting is this week, to sort of affect some policies as well to try and stimulate things.
I think, global yields will move lower, and I mean, I don't know what RBI will do, but I do feel that lower oil prices and US interest rates moving lower is supportive of lower rates here as well. As far as IT and pharma are concerned, I think, on IT, we all know the issues. The valuations per se, unless there are significant downgrades in the future, the valuations are pretty reasonable. I mean, you can look at trailing dividend yields, cash yields are quite attractive, but there is some uncertainty. So I would say, it's, as I said earlier, there are very few sectors which are offering deep value in this market, and the dispersion in valuations is also rather low across sectors.
Prashant, you sort of briefly touched upon the role of the Reserve Bank, and we'll hear from them later this week. From a government standpoint, do you see any need to change anything or anything additional? Because like you outlined, I mean, exports is not that big a part of our economy to begin with. But would you want to see any additional measures in terms of spending or a change in the pattern of spending, etc.?
I'm not a macroeconomist. I think we are doing reasonably well, but we should keep on growing around 6% by and large. And I think, I would say things are quite okay. Things are quite okay.
Including in the PSUs? The PSU basket, but interestingly, we had that Mazgaon doc OFS just last week in timing. Now that the markets are cratering quite a bit.
I don't want to comment on individual stock specific names, and yes.
All right, Prashant, we'll leave it there. Thank you very much for taking out the time, being with us here, and I hope we are able to speak more. As this story develops, as you said, anything can happen in the near term. Markets tend to overshoot on both sides, but it's good to get that perspective as things stand. Appreciate it.
Pleasure. Bye.